Hello ladies and gentlemen, welcome back to the channel. In today's video we're going to be covering a very interesting article posted by MarketWatch. As you guys can tell from the title, it is an opinion. Most investors now expect the US stock market to crash like it did in October 1987. And it says why that's good news, which is, obviously that's a little bit of a throws you for a loop quite a bit. But before we get into that, if you haven't already, go ahead and smash the like button if at any point in time you do enjoy something you hear or you learn something from this video. Also subscribe to the channel as we continue our climb to 1,000 subscribers. And before we get into it, we'll check the Dow real quick. Currently down 167 points, or about 0.6%. After the massive day of losses yesterday, we continue our trend of negativity in the market. And we can check the VIX real quick if we want to. And the VIX is continuing to climb, which means that volatility is continuing to go up, which is kind of what you can expect at this point in time, with the election, with the uncertainty in general with the virus, whatever it may be. All of those different things. But let's get right into the article since the Dow isn't doing a whole lot of movement today. Individual investors have never been more worried about the U.S. stock market crash, about a U.S. stock market crash. That's great news. So it's very counterintuitive. Like it says right here, this counterintuitive reaction is because investor sentiment is a contrarian indicator, so it would be more worrying if investors thought there was a low probability of a crash. This upbeat news will be particularly welcome after the Dow Jones Industrial Average plunged 650 points, or 2.3% on October 26, which was yesterday, the worst one-day decline since early September, which I made a video on yesterday, and several other channels made videos on. So if you haven't checked those out, go ahead and watch my video and go watch some other videos if you would like. Historical data on investor beliefs about crash probabilities comes from Yale University finance professor Robert Shiller. For more than two decades, he and colleagues at Yale have been surveying investor sentiment by asking the following question: what do you think the probability of a catastrophic stock market crash in the United States, like that of October 28th, 1929, or the Great Depression, or October 19th, 1987, which is very strange how they're so closely related in date in the next 6 months, including the case that a crash occurred in the other countries and spread to the United States. An answer of 0% means that it cannot happen. An answer of 100% means it is sure to happen. The chart below plots the results referred to by Shiller and his colleagues as the U.S. Crash Confidence Index. It shows the percentage of individual investors who think the probability of a crash is below 10%. Note carefully that lower numbers in this chart mean that more investors believe a crash is likely. So as you guys can tell, the crash was the probability of it was higher up here, and now in 2020 it is quite low, which again, as it states, lower numbers in this chart mean that investors believe a crash to be likely. Now is one of those times in August. Let me go ahead and pause this real quick. Now is one of those times. In August, the U.S. Crash Confidence Index, the CCI, fell to a record low at 13%, meaning that 87% of respondents believed the probability of a crash to be greater than 10% in September. The rating was still low 15% in September. A close examination of this chart also shows why a contrarian interpretation of the CCI may be warranted. Notice that the other occasion on which it got as low as it is today was the spring of 2019. So if we go back, or 2009 I should say, here's 2009, very low, and we're actually lower than that at this point in time. Now obviously you got to take this with a grain of salt. This is people's opinions, and this is an opinion article, as you guys can see up there. But sometimes, especially a bunch of individual investors start pulling money out or whatever it may be, that can sway the market And while it's an opinion, it still holds quite a big impact in the market as a whole. That coincided with the bottom of the financial crisis-induced bear market, a great time to invest in the stock market. And that is the bright side of a crash, is there are going to be lots of great opportunities if you have the money to invest. To be sure that early 2009 experience is just one data point, but strong statistical support for the contrarian interpretation emerged when I analyzed the CCI Bank to 2001, which is when the survey began to be conducted monthly. The table below summarizes the S&P 500 average inflation and dividend adjusted return in the wake of the highest 10%, lowest 10% ratings. So lowest 10%, which is where we're at currently, 24% return, 45% return over the subsequent 24 months. At the highest, you have your pretty average 9.5 and then 10.6 over subsequent 12 months and then over subsequent 24 months. The strongest results are at the 24-month horizon, where the difference between the return shown in the table is significant at the 95% confidence level that statisticians often use when determining if a pattern is genuine. The difference in the table at the 12-month horizon is of marginal statistical significance. Open to interpretation. Obviously, you guys can take this with a grain of salt. You can fully believe this. You guys may believe this yourself. And if you do, or if you just have an opinion on this in general, go ahead and leave that in the comment section below. I'd love to hear from you guys down there. Me personally, it's really hard to tell. There's a lot that goes into it. A lot of uncertainty that has been brought about by 2020 as a whole, by the virus, by the election, by whatever it may be, which obviously you don't like to see. My analysis of the CCI is not the only way to interpret it. In a recent opinion article in the New York Times, Shiller pointed out a big difference between now and the situation that prevailed in the spring of 2009. Then the stock market was far less overvalued than it is today, as judged by the cyclical adjusted price earnings ratio, or CAPE, if not outright undervalued. The market's strong performance after the spring of 2009 might therefore have been a reaction to the market's valuation rather than a contrarian reaction to the widespread crash anxiety. If so, then contrarians should think twice before concluding that today's widespread crash anxiety is equally bullish. Furthermore, Shiller added, there is a behavioral basis for concern. Anxiety increases the chance that a negative self-fulfilling prophecy will flourish, which is kind of what I said. Obviously these are just people's opinions, but at the same time, if enough people believe it, it may become true. And that's kind of how it works for everything, not just the stock market as a whole. I nevertheless cling to my analysis, since even after eliminating 2009 from the sample, the contrarian interpretation continues to enjoy statistical support. An email to Shiller requesting comment was not immediately answered. So this is a very, very interesting article, and essentially, it's going to be a bumpy ride here over the course of the next couple weeks, over the course of the next potential several months. I think the next 6 months will be very interesting to see what happens, especially if, obviously if there's a new president, or even if the current president stays in office. I think a lot of things are going to look different. And, whether that's not having to wear a mask out anymore. Obviously, there's a lot of mask fatigue going on. I don't think anyone necessarily likes wearing them, but it's going to be a really interesting 2021 to see how things potentially transition, to see how much progress we can make, and hopefully everything goes smoothly. Obviously, not everything is going to go smoothly, but that's the best we can hope for at this point. And hopefully those things come about, and hopefully we have people at the helm that will do it for the protection of U.S. citizens or whatever country you're from. Hopefully your leaders are doing things for the right reasons and for your people. And, wild times here in 2020. So I'd love to hear from you guys in the comment section below, your opinions on the article we just read, your opinions on whether or not you're buying any stocks, whether you're waiting out to potentially hear the election results or whatever you may be waiting out for. Go ahead and leave those in the comment section below. If you haven't already, go ahead and smash the like button and subscribe to the channel. And until next time, happy investing.